Welcome to Horizon Advisors Q3 Quarterly Review. I'm Jay Shook.
I'm Brad Spindler.
And today we're going to start off with one of the oldest, maybe at least best known quotes in our industry. Be fearful when others are greedy, and greedy only when others are fearful. Most of you have probably heard that. That's Warren Buffett. And I think it actually applies today, even though everyone has heard it pretty well. The question here is, are we being greedy? What do you think, Brad?
It's a great question. That's the $1 million question in today's market. I personally don't think we're being greedy. Now, time will tell. We should see over the next few years. I think artificial intelligence is very real and is making companies more productive. It's making us more productive in our day-to-day jobs, Jay. But that is the big question.
Yeah, I think if you take a look at where we're at on valuations, which we'll get a little more in depth here in a moment, things are what we would describe as expensive or stretched. And it doesn't necessarily mean that is greed. It could just be things are priced fairly based on the assumptions of growth in the economy and in our stock market as well. But that's always one of the hardest things to really determine as we take a look at what's going on and when is a good or fair value or a fair point to invest in this market. I guess before we dive into that, what have we seen so far this year just in the market performance?
It's been a wild ride this year, to say the least. In April, we were down 20%, so we entered bear market territory, and now we are back to full bull market territory. The S&P and the major U.S. indexes are up double digits this year. International is still leading the way. International is up over 25%, and we're seeing a real return from bonds this year over inflation, which is great to see. It's been a while since we've had that, Jay.
Yeah. I think, beyond just having a good year in the market and really a good few years, the key is to take a look and say, what are the valuations, right? I always tell people hitting new all-time highs isn't really a abnormal thing, right? If we assume that the economy is always growing, at least over a long period of time, we should see new highs. If not, that would mean that we're entering something similar to a permanent recession, and that's no good. So the all-time highs isn't really the thing that can dissuade me from getting into a market. But if we take a look at the actual underlying valuation, we talk about it, I think, in every video. CAPE ratio, I think, is a good metric. You're looking at the company's previous 10 years of earnings adjusted for inflation and what the multiple is on their price point relative to that. Right now, our CAPE ratio is over 40.
That's high.
Yeah. The last time we saw this, really for any at least period of time, was in the dot-com bubble. It didn't really turn out well. We saw a major pullback, at least in very specific sectors in the stock market back then in 2000. And then, of course, that drawdown could have hurt you if you were investing in the wrong places. But beyond that, another metric that people know would just be your forward PE ratio, which is just sort of what the assumption is as far as how much the companies are going to earn over the next year, and then the multiple on that. Right now, we're sitting at 22.5, still a very high number. I mentioned in the newsletter, but is something that's a more recent point where you could look and say, well, what was it when it was a bit cheaper? We were around 15.5 back in 2022 when we had that bear market, and we've really come up a lot since then. So it's hard to say, if this is a good place to get because of the reasons, or get invested because of the reasons we already mentioned, in the sense that we do expect pretty good economic growth. We've seen margins really improve for various reasons. So maybe it is a fair valuation, but a lot of people out there would definitely say investors are being greedy. I think part of that's going to be what you might touch on here in a minute, but would be the assumption of rate cuts, right? That seems to really motivate investors right now. What do you see in there?
It definitely is driving the market, and especially small caps. So the Fed did cut rates in September, 25 basis points. It was the first time they've cut since last year, December. So now the Fed target is around 4 to 4.25. The Fed is also projecting two more 25 basis point cuts before the end of the year. We'll see if that happens. They have made it very clear they're data dependent, so it will depend on the data in the later months of the year. Do you think we'll get 2 more cuts?
That's what they're telegraphing, but I don't know if the Fed always knows what they're going to do. We've seen for a long time. After 2022, the assumption was pretty significant rate cuts relatively quickly, and the market, at least initially, was pricing that in. Didn't really come to fruition. We really haven't seen big moves. one of the things I say quite frequently is generally the Fed doesn't really move until they do, meaning they generally move pretty slowly unless something occurs, whether that's unemployment, maybe the drop of inflation. I mean, it's been pretty steady, but nonetheless, there just hasn't been a major triggering event to motivate them. And then, of course, we had the uncertainty earlier in the year surrounding trade deals, tariffs, things like that. And I think that they were very hesitant to move with all that information out there. But it's just something nobody really knows until it happens.
Exactly. And the more important rate is the 10-year U.S. Treasury rate. That's what mortgages are based off. A lot of long-term financing, car loans, all of that is based off the 10-year. That has came down this year. We started the year at about 4.5%, got all the way up to 4.9%, and we are down to 4.1% now. If that goes below 4%, we should see a lot of relief in these long-term financing rates, but that's to be seen.
Yeah, I think as you look out, I mean, it's still an unknown. The 10-year can be reflective of what sort of the market is pricing in, and that's a good point. I mean, you have seen it climb down a bit this year. It is creeping down somewhat at the same pace as what the Fed is doing on cuts. They are working together here. But at the end of the day, it's still going to be a tough call. I mean, if you take a look, though, what right now is really in the market? I mean, what's driven the rate of return? I mean, we've just kind of made it clear. We haven't seen major rate cuts. Where are we seeing that growth?
It's a great question, and for once, we're seeing a broadening out. So since 2023, there have been really 7 stocks that have driven the market. We call them the Meg 7, the mega cap tech companies. But this year, we are starting to see a broadening out. It's not to say the Meg 7 is not performing well. They are up about 21% year to date. But the top 10 performing companies in the S&P 500 this year are not the Meg 7. They're having great years. Small caps are also doing well this year, Jay. Since the April 8th lows, the Russell 2000 is up 39%, which is more than any other index from that time. So if we continue to see a broadening out and more depth in the market, I think that's overall a good sign.
Yeah, I don't disagree. The one thing that still is a bit maybe concerning would just be what we've seen as far as job growth. It's very steady for a long time following the 2020 shutdown or whatever you want to call it that we experienced. There was significant job growth, a lot of hiring, and that went on for years. Now we're starting to enter sort of a phase where that has sort of leveled off to pretty much a flat number. We're not really seeing, a big spike in unemployment yet, but we're also not seeing those numbers, the job numbers, as far as how many people are actually working going up. And, if that trend can continue down or does continue down, that's going to be scary to a market. But of course, on the other side of that type of thing can lead to rate cuts, even more drastic than what they've been doing, sort of back to what we said a minute ago, where the Fed doesn't really move quickly until they do. Those are the types of events where you could see a big move there. And then is the market excited enough that we've seen a significant rate cut to offset maybe job losses and things like that? So it's going to remain to be seen and really, how bad or if the job losses continue. And again, I mean, what does that even mean? Because we're seeing that in the meantime, increased margins and companies being more profitable. So it's tough to say. It's a pretty unique environment, something new, especially with the advent of artificial intelligence. But I don't know where we're headed as far as the job market and what, where we're really going to sort of plateau or level off. But the other side of that too is that one of the things we've been discussing off the air, which is the actual fact that people may be buying homes again soon.
Great point, Jay. The housing market has been locked all year. It's starting to become slightly unlocked. Part of that was because rates. A lot of people got locked into high 2%, low 3% mortgage rates in the 2020s. Now mortgage rates are about 6.25%. They started the year at 7%. So not many buyers were in the market. Affordability was a problem. And, housing prices have remained relatively flat, but things are sitting on the market for longer than they have in a long, long time. We have seen a recent uptick in mortgage activity. Now, most of that is refinance, probably from people who got stuck in the mid-sevens. What do you think about the housing market at this point, Jay? Do you think it's going to unlock?
I mean, I would assume if rates come down, you're going to see a lot of people that are trying to move. I mean, I've talked to enough individuals that have been waiting for rates to drop where they feel comfortable, buying a new home, taking on a new mortgage, giving up their old lower rate mortgage. So I wouldn't be surprised, especially if the Fed keeps pushing rates down and the 10-year comes down, as you mentioned earlier. So it'd probably be pretty organic with a drop in rates.
I agree. And housing is a huge part of the economy, the U.S. economy. And since it's been stalled, not many new homes have been built. If we get a housing unlock, that is positive for the overall economy. So it could be another catalyst for the market heading into the end of the year and early next year.
Yeah, I think, looking ahead beyond just housing, jobs, all these different things, there's going to likely, you would assume, some level of volatility simply because we haven't really seen it since April. On top of it, I mean, historically, September, even though the month is ending right now, not usually a very good month as far as relative to the other months as far as rates of return. The same for October. But I wouldn't be shocked to just see some movement out there, and that could create a little bit of fear. But still, a lot of reasons to be optimistic. There's a reason markets are expensive, and we'll see where we go from here.